You are the author when it comes to Wall Street culture. There's no one else out there. But in terms of reaction, you have never gotten such a visceral reaction in such a short time. What do you make of all this?
It does. I've had one experience kind of like this, and it was when I published Moneyball. But in that case, they weren't threatening to throw old baseball scouts in jail for what they did. But the disruption to the industry that caused feels a lot like this. And the instigator, there's a character kind of who is taking a different view of the industry and has kind of investigated it one way or another. The main character of this book, Brad Katsuyama, has got a similar feel to me to Billy Beane. So I feel the reaction it reminds me of that everybody has to have an opinion about the book right away, no matter if they read the book or not. So that's similar.
But is the opinion about the book or about the claim the market's rigged? That's a big claim. Yeah,
well, it is rigged. So it's not that big. You read the book, I don't think you can put it down and say the market's not rigged. I really don't think you. I mean, unless we can parse the word rigged.
Maybe we should.
So let me give you an analogy that I think is a very close analogy to the way the stock market's structured. It's a casino analogy. So I have a casino, and I want to start a poker game in the casino. So I get 3 card sharks, and I tell them, go sit there and start the game. Make it look like a good game's going on. There are no 4s, there are no 9s, there are no queens in the deck. Only you will know that. And we will pay some tour group operators to bring like a bunch of dumb tourists in to play with you. They won't know. You'll win.
Hold on. Tourists. David Einhorn's a dumb tourist?
Yes.
Come on now.
In this analogy, hold on. In this analogy, every investor, David Einhorn did not know. He did not understand. He understood that whenever he tried to do something in the market moved, like someone knew what he was up to. In the same way that big pension fund managers and mutual fund managers saw when they tried to execute big orders, oh my God, it's like someone knows I want to buy before I buy. But he didn't know why. He didn't understand that high-frequency traders were putting machines in exchanges to be closer to the exchange so that they could get price information 2 milliseconds before him, and so on and so forth. Can I finish my analogy?
Absolutely.
So here's the analogy. So of course, the tourists get fleeced all the time in the poker game because they don't know that the deck is rigged, right? The poker players pay the casino a cut of what they make. The casino operators pay the tour group company money to bring in the tourists. In this case, casino is the exchange, the poker players are the high-frequency traders, and the tour group operators are the banks and the brokers that handle the stock market orders. And I think the analogy is pretty close. So is that rigged? Is that a rigged game? I think it is a rigged game.
Well, it's rigged only in as much as rigged.
So let's use the
casino analogy.
Why are you so invested in the idea this is fair? Why are you even arguing about this? It's so clear.
Me?
Yeah, you seem to be. So why?
Actually, we've just been
no. But
it's
very interesting. No, but you seem to be. You can see it's very clear that people are being front-run in the market. There's plenty of evidence in the book. People making tests in the market.
Their orders are being anticipated and inferred.
Anticipated and run in front of it. That's right. And why?
Well, no. There's some people. I mean, in all fairness, I don't have a stake in the proceedings here. Certainly not like you, because you're the author of the book, Michael. But there are some people.
Right.
You've probably met some of them who would say, in order to front-run, you have to have a client.
Wait, I'm sorry.
In order to front-run, you have to have a client. And the HFT firms don't have clients.
They buy the order flow. They pay. I mean, we're talking Main Street.
They pay to see things.
They pay to execute the orders. So they pay TD Ameritrade tens of millions of dollars a year. Schwab. They pay E-Trade. So they pay for the right to execute the orders at a delayed price. So why would you? I mean, ask that question. Why would anybody pay for the right to execute someone else's stock market order? That in itself is a little curious. I mean, I can understand why, if I'm a stock market investor, why I would pay a commission to a broker to handle my order. But why on top of that is the broker turning around and selling my order to some high-frequency trader for the right to execute it? Where's the value in that? The value in that is quite clear. It's that that order for the high-frequency trader is an opportunity to exploit. And it's an opportunity to exploit because he has advanced information about the pricing in the stock market. Is that fair?
He's also getting paid by the exchange to print, right? To print the trades.
It depends. I mean, now you're getting into a complicated discussion because the exchange pricing, sometimes you pay and sometimes you get paid. So that's almost a separate issue. It is true that the exchanges create incentives to be on one side of the trade or the other. And I think that basically when you look at it, at the bottom of this is a bit like the financial crisis. At the bottom of this is that the system is riddled with really bad incentives. I mean, it doesn't make a lot of sense for brokers to be owning exchanges, I think. I mean, that in fact, the exchanges are for investors, not brokers, not for middlemen. When the brokers own the exchange is going to be essentially an instrument of the intermediary rather than the
All right, then are the exchanges sort of the, like how what the rating agencies were in The Big Short? Is that what the exchanges are here? And if they weren't for profit, if they weren't for profit,
right,
would they be a better force, a force we could trust more?
It's a similar sort of role. That analogy is probably, but yes, it occurred to me that's actually sort of the role, that they're thought to be, their role, it's a kind of utility role. You need them to be an honest broker. You need them to create a fair experience for a customer who walks onto them. And because they are for profit, they're incentivized, and because of the way the markets work the way they work, they have to meet quarterly earnings and so on and so forth. It's not a long-term view they're taking, it's a very short-term view they're taking, that they are constantly subjected to the temptation of taking money from one faction of their clientele to put the other faction in a bad place.
Would we like these HFTs more if they actually were putting money at risk, if they had positions?
Yes.
The fact that they are just taking
Yes.
a scrape here, is
Yes.
that why we dislike them so much?
The fact that they're sort of set up not to take market risk. It's funny.
I want you to have skin in the game. If you have skin in the game and you could lose, I like you
If you
more.
could have, 4,000 trading days without a single day's loss, something's a little weird, right? I mean,
yes,
right.
But let's rewind the clock to pre-1975 when there weren't really market makers the way there are now. There were, trading was largely an agency business. This is before Gus Levy and before the arbitrage desk at Goldman Sachs and Robert Rubin. They didn't lose any money either. You don't lose any money as an agency trader.
Oh, it's not true that they didn't lose any money when you rewind the clock. I mean, I worked on Wall Street. The Salomon Brothers, the traders would have down days and they'd have up days, and they just hoped the up days were better than the down days.
But they were putting money. They were putting money at risk,
and they were putting money at risk.
Right.
The position they were taking. I mean, I'm not saying that was pure and innocent and great either, right? I mean, but there were different problems in different days. But the role they were playing was a buffer in the market. They're playing the role that Brad Katsuyama played at RBC, that someone needs to sell 1 million shares of something, and the market isn't ready for that.
But
and
you know what?
They'll sit in the middle.
You're actually, here's one. I'll phrase it as a question instead of making a statement. Would you acknowledge that your critics perhaps have one fair point, which is that it's hard to generalize, that much of what you're talking about, much of the people whom you identify as the victims in the book are by and large institutional traders. Some of them are mutual fund managers like
Can I stop you there? Can I stop you there? I'm sorry, but in the book there's a long interview with the guy who spent years selling the order flow for TD Ameritrade. I mean, that is not.
I read it.
That's not institutional investors. That's you and me. That's mom and pop. And he says, what's the most valuable order for a high-frequency trader to exploit? It's a market order from an individual investor, because the individual investor has such a slow feed, basically. No, it's true. Now, what is true, if the order is a 100-share order, it's probably not that big a deal. It's not that big a deal.
Right.
That's true. But
well, a lot of retail orders are 100 shares.
But who manages the savings of most people in America? It isn't people trading 100-share lots on E-Trade or Ameritrade. It is mutual funds, it's pension funds.
But be careful who you defend here. Actively managed mutual funds.
Right.
We could talk about the passive ones separately,
right.
But actively managed mutual funds, on the whole, do a terrible job of overseeing Americans' money. Right? They fail to beat the market more than 50% of the time. And they charge a fee on top of that. I mean, here, we were going to get down to this, but let's do it now. How do you decide who to put the white hat on?
I didn't put a
white hat. White hat guys?
I didn't actually put a white hat on the mutual fund industry. I hope you don't think I just did that. But But it doesn't help that in addition to the ineptitude of the mutual fund managers, they have to pay this tax. It's all a cost to the ultimate investor. So I mean, I'm not an apologist for the mutual fund industry. That's not the point. The point is the people whose money they're managing, it's ultimately damaged by this, are lots of little individual investors. And so it's to say that like this doesn't touch the individual investor is crazy. The second reason it's crazy, and this gets to Goldman Sachs' recent involvement, is that in order to preserve, essentially, a stock market system that enables this sort of activity, the level of complexity has gone through the roof. And basically nobody the reason I write a book about this is nobody understands the stock market. This guy can walk in and describe a stock market that nobody understands, and David Einhorn listens to him and says, oh my God, this I did not know. The complexity is a source of instability. The people at Goldman Sachs I talked to who have thrown their weight behind this exchange said the main reason they did it was that the outages at the exchanges, the flash crash, whatever it is, the various technical mishaps that seem to, punctuate the life of the stock market these days. They see it all as symptomatic of a much bigger problem. They said there's going to be a massive flash crash times 10, and Goldman's going to get blamed, so we got to get out of this before that happens. So that's not good for the individual investor either.
But is this still material to the individual investors? Because today, when I go to execute a stock, I definitely feel like, man, how did that get jacked right in front of my face every time? I do feel that way. But 15 years ago when I did a trade, I was paying significantly more to do it with a specialist because of what the fees were.
So you got to make a distinction here.
So it's a different problem in different days. Is it really worse today than it was when specialists were on the floor?
I never said that.
Then has the system always been rigged?
Yes. I mean, in different ways. In different ways.
No,
hold on. In different ways. The problems then were different from the problems today. And you're not making a distinction that I think is really important to make. Yes, technology has brought incredible benefits to the individual investor. It's really good that trading is computerized. I'm not against computerized trading. It's that it does not have to be computerized scalping going on with computerized trading. The two are they're not inextricably linked. They're separate things. What really should happen is that you get to all the benefits of the computerized trading without someone running in front of you when you trade. That's what should happen. And there's no reason that can't happen. There's no reason that can't happen. And I think part of this is a larger discussion about the state of Wall Street. But what's happened here is that technology has basically eliminated a role Wall Street used to play. You used to need a human being to bring together a buyer and a seller. You couldn't do it yourself. You couldn't. Now you hit your button on your computer and your stock market order go into a box with everybody else's stock market orders.
And you don't feel good about that?
That's good.
That's what I'm saying. That's
good. The problem is
some guy jacking me.
But some guy is still jacking you, and that's the problem. Is you've got traders who take all this unnecessary financial intermediation happening. Wall Street's found a way to insert itself in the stock market where it's no longer necessary. And there's all this trading happening between intermediaries and you and me that just don't need to happen.